Welcome to Upticks with Jake Falcon, founder and CEO of Falcon Wealth Advisors. In this podcast, we help high net worth individuals overcome financial complexities. We do this by enhancing financial literacy and discussing topics in a language free from industry jargon. Join us as we help explain exactly what having a solid financial plan means, as Jake draws from years of experience in helping hundreds of individuals get financially organized and focused on their goals. We hope you find Upticks educational, entertaining, and shareable. Now, on to the show.
Welcome back to Upticks with Jake and Cory. Cory, welcome back to the show.
Hello, Jake. Thank you for having me back on the show.
And I want to thank all of our viewers and listeners out there. Our subscriber count is quickly growing. We're getting a lot of great feedback from our clients, so this has been a lot of fun. I'm excited that we have changed the format, Cory, and I think it's providing a ton more value than it was before. So thank you for everyone that's tuning in. The best way for more people to watch and listen to our show is for you, our viewers, to subscribe, like, and share our content. So if you think it's any good, please give us a thumbs up, 5-star ratings. All of that is much appreciated. Again, the whole purpose of Upticks is to enhance financial literacy at scale. And today we have hundreds of people downloading our content. We would love to get that out to thousands of people somewhat soon.
One episode at a time, Jake.
That's right. Incremental to exponential, Cory.
That's right.
All right, let's go ahead and dive into today's topics. Cory, why don't you kick us off?
All right. The spectacular failure of SPACs. What have you got here, Jake?
Yeah, so I started us off here with a somewhat complicated subject, and I just want to really simplify it, and then there's an overarching reason that I brought it up today, Cory. But what SPACs are, first to define them, is they are special purpose acquisition companies. They're commonly referred to as blank check companies. So what this means in English is that a company will go out there and get listed on the New York Stock Exchange, but it doesn't really have a company. And so it's a shell company, for lack of a better term. And the idea is that they want to bring in private companies that would otherwise have a hard time getting listed on the New York Stock Exchange, Cory. So they buy these up and then they basically make them public because they're already public. So it'd be like, again, it'd be like a public company buys a private company. Well, that public company now owns it. They're already trading on the exchange. Bada bing, bada boom. It's all good. Everybody's public. They're all trading on the New York Stock Exchange. These were very popular a few years ago. And my takeaway, so what's happening though, is that now they're doing horribly. And my takeaway, Cory, is that many of these SPACs are of little value now and have returned unused capital back to the investors. So my thought is, if a company isn't good enough to get listed on its own, then it probably doesn't belong in the market to begin with. Cory, what are your thoughts?
Yeah, the reason the barrier of entry is the IPO process is for a reason. And I do think that evaluating the last few years, there's a lot of companies that were brought public via SPAC, like you've talked about, Jake, that have really just left a lot of shareholders with some big losses. They're probably companies that maybe shouldn't have gone public in the first place, but it's not my decision to make.
Right. So two important lessons here, Cory, is one, you can lose money in the market. People should know that, hopefully. And two, these fads are fads for a reason. If it sounds too good to be true,
yes,
then it probably is. What's wrong with just sticking with tried and true? You look at these guys like Warren Buffett that have kind of done their thing for 50 years, and it's worked out pretty well for them. So again, they kind of stick to their knitting, focus on hitting singles and doubles, don't get caught up in these fads. That's really the lesson.
Stay away from the shiny toys.
That's right. That's right. All right, for the next headline, Cory, we've got 4 lucrative tax deductions that seniors often overlook. So let's hear them.
4 of them. 1 is the extra standard deduction for someone who's 65 or older that meets the eligibility. There's an extra standard deduction for those folks. 2 is spousal IRA contributions. 3 is qualified charitable donations. And 4 is the Medicare premium deduction.
Nice. Yeah, these are actually overlooked. These aren't things that I talk about on a regular basis, Cory. So, I mean, again, they come up in client meetings. They should be coming up with their accountants, frankly. But
Correct.
So again, you get an extra standard deduction. So if you're not basically itemizing and you're 65 or older, you may be able to deduct more than what a standard deduction allows for. Is that what I'm hearing?
Yep, that's exactly right.
Good, good. And then if you're still working, even if your spouse doesn't work, you may be able to contribute to their IRA for them, right? As long as, again, certain income thresholds
Which helps
are met.
exactly.
Good. Qualified charitable donations or distributions are a great thing for individuals 70 and a half or older. So again, that's something if you're in your 70s and you want to talk about it, let us know. And then the Medicare premium deduction. So talk about this one a little bit, Cory.
Yeah, so if you are a retiree who is self-employed, which is a little confusing to think through. So if you are a retiree and you are self-employed, you can deduct your
Wait a
Medicare
minute,
premium.
isn't that like a oxymoron?
I think so, yeah. But I think the idea here is if someone's retired or of retirement age is I think what the article is referencing when they say retiree. And if you're self-employed, if you are paying Medicare premiums, you may be able to deduct those even if you don't itemize and they are not subject to the same 7.5% threshold that healthcare expenses must make up for someone to be able to itemize them. So I would imagine that one is it's overlooked as they've highlighted in the article, and it may be less pertinent for a lot of people, but it is a deduction nonetheless. And the last point I want to make, Jake, is I was thinking when I was reading this, why are these overlooked? Like the QCDs, for example, the qualified charitable donations. I would speculate that we've maybe talked about those 20 to 40 to 50 times on the show over the episodes, but they made a great point that our tax code in the United States is complicated. The rules about exemptions are constantly changing, and there's been 5 big tax law changes just since 2017, which leaves the average person ultimately not sure where to start in order to actually take advantage of the tax code as it's written today. So I'm glad that this was written about and wanted to make sure that we highlighted it.
Yeah, Cory, I think it's a great opportunity for a call to action. So it's December. We're running out of days for the year. Now is the time to book an appointment with a financial planner at Falcon Wealth Advisors. We can take you through our tax planning process. Now is the time to book time with your CPA or accountant to review these things. Now is the time to fire up your tax software. If you're a do-it-yourselfer, fire that sucker up now, and let's take a look at some things to educate yourself to make sure you are set up to pay the least amount of taxes in 2023, right? And then our planners, they're actually looking out 10, 20, 30 years for our clients. So they're doing more planning further out, but now is the time to do that. It's a call to action. Don't wait until April because you're going to be kicking yourself. You're going to be kicking yourself. Too late. Good one, Cory. Thanks for including that article. What's next?
Let's talk about the big disconnect in returns for the S&P 500 and the S&P 500 equal weight index.
Right. So for many of our clients, they understand, Cory, that we actually subscribe to more of a philosophy where we prefer an equal weight portfolio from a diversification standpoint. This is a little technical, but bear with me here. So if you invest in the S&P 500, which is the 500 largest companies in America, it is currently considered what is technically called cap weighted, meaning bigger companies actually make up a bigger portion of the index. And so what they've coined as the Magnificent Seven now make up, I think it's around 80%, Cory, of
That's exactly right.
That S&P 500. So some do-it-yourselfers out there will argue, I just want to buy the S&P 500 and not pay an advisor. But in essence, what you're really doing is putting 80% of your money in 7 stocks, which if I told that to a client, they'd probably look at me like I was crazy. Like, I have $1 million, Jake, and you're going to take 800,000 and put it in 7 stocks, which, by the way, are pretty overlapped in form of sectors. Like, they're mainly tech stocks, right? So what we do instead is we don't overweight 7 stocks, and we take an equal weight approach to our diversification for our clients. And this year, though, and this happens, the S&P 500 is big time outperforming the equal weight index. And the reason? Those 7 stocks happen to be having excellent years, okay? Now, last year, that S&P 500 drastically underperformed the equal weight index. And why? Those 7 stocks had horrible years, right? So
yep.
I had our portfolio manager, Connor, do some research for me, and he told me that the average disparity, this is going back 20 years or so, is around 5%. So that's the average. This year, I think it's over 10, I believe. And so My point is, again, the takeaway here is don't compare your performance against the S&P 500. You really should be comparing it against your financial plan and your target rate of return. And then if you need more of an explanation of why your performance is what it is, I would challenge you to reach out to your financial advisor, or certainly if you're a client of Falcon Wealth Advisors, you can certainly book time with me or Cory or someone from our financial planning group, and they can go through and dissect your portfolio and show you exactly why your performance is what it is. So again, not something we're concerned about. From our studies, Cory, at the University of Pennsylvania's Wharton School, the big argument out of that, college is that the equal weight outperforms the S&P, and that's why we subscribe to that notion. But we understand that there's going to be years where we outperform, and there's going to be years that we underperform. And really, what we care about is diversification. You have thoughts on this?
Yeah, exactly. I think the points you've made about 2023 and 2022, and a lot of the conversations I've had with clients, fact of the matter is we want to, of course, participate when things do well in the market. But for most of our clients, if they're retired, if they're approaching retirement soon, mitigating the downside is really important, which we were starkly reminded of during 2022. And that's the reason that we take that approach. We don't want to try to predict the future. We don't want to guess what we think is going to do best. We want to have the right allocation and aim to pick the best companies in those different styles and sectors. But ultimately, it's about achieving the rate of return, because that's what makes the financial plans work for our clients. And that's what allows them to do the things they want to do in retirement.
Awesome. Yes, I agree 100%. And I thought it was good to bring on today's show because it is a little bit different than a lot of individuals or other advisors, a different approach than what other people take. And I think it's important for us to highlight it here. Now, again, full disclosure, this is not investment advice. That's not what I'm suggesting. I'm just talking a little bit about how we do it for our clients. And again, if you want more information and how it pertains to your financial plan, simply email service@falconwealthadvisors.com, and we're happy to set up an appointment to talk all about it, because we love talking about it. We talk about it all the time.
We do.
All right, Cory, the next one is, why is everyone so unhappy at work right now? Uh-oh.
Despite, Jake, wage increases, more paid time off, and greater control over where people work, the number of workers in the United States, according to the 2023 Gallup Workplace Report, says the number of workers that state that they are angry, stressed, or disengaged continues to climb. There is a chart that we have to display here that shows employee satisfaction. And really, this boiled it down to companies have moved past their pandemic operating mode. So they're focused on cutting costs and focused on productivity. What I found interesting from this, Jake, basically what my big takeaway from this article is that people say they don't like being micromanaged back to the office, but they find hybrid and remote work isolating. It's fascinating that people want to have their cake and eat it too, frankly, and that they're going.
Hold on. So you're saying people are arguing that when their employer says you've got to come back to the office, they feel micromanaged, but then they also don't like working from home. Is that what I heard?
That's what you heard.
Wow. That's perplexing to me. What do you think
that
about
tells
that?
Me that someone who feels that way is going to be unhappy no matter what. They may be looking for happiness in the wrong places. But I found it surprising. Another big takeaway from this is that what occurred during the pandemic in 2020 and 2021, it's surprising really how many people made major life decisions expecting that to be the permanent new normal. And I found it interesting. Jake, they highlighted in this article one specific worker who said, if you would have told me before the pandemic that my job would allow me to work from home 3 days a week, that would have been a dream come true. But this exact same person said that after they were getting called back to work, it felt like a step back professionally, and they didn't want to have to go back to work, even though they acknowledged themselves a few years ago, they would have been thrilled to work from home 3 days a week, but now they just felt like it was being micromanaged and ultimately felt like it was a step backwards. Very silly.
That's very weird. Now, do you remember when COVID, broke out, everybody thought it was going to be, we've got to isolate for a couple months, first weeks,
I remember
months. I remember somebody was like, we're working from home till July. And I was like, wow, that sounds like a long time, right? And you're right. I think it's fascinating how people it's a horrible event, obviously, it's a pandemic, but they use that to think that would require a permanent change. And, we're very fortunate, Cory. We didn't have to mandate our employees come back to work at Falcon Wealth Advisors. Most of them wanted to come back and work in the office. I think we've got a fun environment, a sense of community and collaboration. that you can't get working. Now, we do have some older clients that have worked at their jobs for 20, 30 years, and they love it working from home. But I think the flexibility is good, but I also understand from an employer perspective that, look, you've spent millions of dollars on real estate and, studies and building things out to not only make an effective company, but to make it an effective place to work. And to let a pandemic mess that up, it's kind of silly.
Or to assume that's never going to be the same way again.
Right, exactly. Because that happened, that means it's permanently changed. No, it doesn't have to permanently change. Because now, if you see an opportunity and some of your workforce can be remote, that's awesome. But again, yeah, I think it's silly how humans, they, like you said, they want their cake and eat it too.
Yep. Yeah. And real quick though,
it's sad to see though. I hate to see employee satisfaction tumble so bad. That's horrible. I hate to see that in that chart.
One other point that was really interesting about this, though, that they did highlight in the article, which does make a lot of sense to me, is that the dissatisfaction was highest among people that have changed jobs in the last couple of years. And that ultimately part of the reason for that is because these people felt like companies have prioritized trying to hire, but not prioritizing how to train someone once they've started a job. So people feel like there's no honeymoon phase when they start a new position. The expectation is for them to start figuring things out and work from day one. And I think a lot of clients, or not clients, but a lot of employees, according to this, who've changed jobs have found that the grass isn't always greener.
Right. That's a good one. Good point, Cory. Because when you're jumping around jobs, you're just starting back at the bottom somewhere else. Even if you get a raise, it doesn't mean it's necessarily a good thing for your career. So,
exactly.
Good.
All right. Let's talk about the surprise bill coming to those who underpay their taxes, Jake.
Yeah, this is a tough one, Cory. So as of October 1st of this year, the IRS is charging 8% interest on estimated tax underpayments, and that's up from 3% 2 years ago. The increase is one of the many effects, Cory, of rising interest rates. So I know, blah, blah, blah. This goes into your inflation argument.
Sure.
But I get it. I mean, there's a penalty basically for underpaying your taxes. Here's my problem with it though, Cory. Why doesn't the IRS pay us interest when they owe us refunds?
Great question.
That's my bigger issue. So fine, you want to charge people interest that underpay their taxes. I get it. But I've talked to many clients about this, Cory, that the IRS will hold the client's money for months, maybe even longer for some
years.
people. Yeah. And they don't pay you any interest.
Nope.
So I think it's two-faced. I don't like it. I understand why they would want to charge interest, but if they're going to do that, Cory, they need to pay interest on refund. They should say, if your refund isn't paid back to you within a month of you filing, we'll start paying you 8% interest. Why not?
Don't hold your breath.
I
agree.
I feel like, Cory, I would have been one of those people back in the revolution, like leading the charge, like with the taxation.
Time to fight back.
Yeah, I mean, I love America. Don't get me wrong. I just think there is no perfect government. And this is another example of America being a wonderful place, arguably the best place to live. But I think they got it wrong here. They jumped up their penalty basically for underpayments, and they're not giving anything back to the citizens. The good citizens who do pay on time or who are owed money by the IRS don't get any interest. It's like, how's that work?
Yeah, it's a double standard there. But it is, and it's also I've thought about this a lot when it comes to taxes. It's like you need to pay in taxes and it needs to be the right amount, but we won't tell you how much, but we'll penalize you if you're wrong. There's got to be a simpler way.
Right. There's got to be a better way. So, all right, good, Cory. This one's from a reader. From a reader or a listener?
Listener. Viewer.
From a listener.
Yeah, great point. Not a reader.
Yeah, we don't transcribe the blog anymore, but into a blog. Okay, so this is from a listener or viewer. So thank you for whomever sent this in. And the title here is The Ultimate Country by Country Guide to Tipping in Europe. Oh, this is from a show, Cory. So what do you have on this?
Yeah, so this is a bolt-on to a discussion that we had, maybe a month ago or so. And I appreciate, thank you to the client who sent this to me. They said, this is proof that I listened to your show, Cory. Here's what we followed. What I found interesting about this, though, in the spirit, is that there's really not a lot of consistency, because we talked about, tipping in Europe, but they highlighted specifically what it looks like in Italy versus France versus Greece, and also highlighted that really Iceland and Scandinavian countries are the countries in Europe where gratuities are truly not expected. Included in this, though, with some great, I would call them, it's not a chart, Jake. It's more like a picture or a graph that just highlights each country that we can flash up on the screen here just to help people see what it is that we're talking about. But I thought this was pretty neat to see if someone's planning a trip to Europe, because it does highlight ultimately, if you're staying at a hotel, if you're taking taxis, if you're going out to meals, what that looks like from country to country.
Yeah, it's good. And again, thank you for the listener who turned us in. It's tough though, because again, I think I heard, Cory, that France, you don't tip, and then you're saying that it is. So,
and they said there, the advice from experts, Jake, it varies when it comes, the advice from experts even varies when it comes to tipping customs. And in many cases, it comes down to personal judgment.
Right. That's what's hard though, Cory. If you don't know the language,
right.
You already don't know the language. So, and what are you supposed to say to a waiter or waitress? Do you want a tip? Maybe
leave a couple euro on the table, I suppose.
I don't know. A couple euro? That's insulting to me.
3 to 5% in France. 3 to 5% in France.
That's insulting though. And again, I would much rather adhere to their culture. Unlike you, Cory, who said, I'm going to do what I want.
By giving people a tip. Yeah.
I would much adhere to whatever the cultural norms are. But like you said, even the experts disagree. So
exactly.
Very interesting. The US has that right, Cory. Standard. Give me as most you can.
You're right. Yeah, Jake will click the far right button.
America, I don't think there is a tip. I think if you tipped 50% at restaurants, there would be no offense taken by anybody.
No, they'd say thank you.
Right.
Next time, make it 60%. No,
that's right. That's right. All right, good, Cory. I think we've got time for 2 more here.
Yeah, financial gift ideas for any age. What have you got here?
Yeah, so as we come up to the holiday season, I didn't know this, Cory, but the average U.S. consumer is planning to spend $654 on gifts.
Okay.
And the likely purchases go to gift cards, vacation and travel, toys, and games. And this is according to the Conference Board Holiday Spending Survey. I like this article, though, because it gave some financial gift ideas from financial advisors. So one of the big ones for children would be 529 plans. So again, these are college savings plans. You also get a little bit of a state tax deduction, potentially based on where you live. UTMAs would be basically custodial accounts for minors. The idea behind this one is teaching your kids, maybe they're not young children, maybe they're old enough to understand the concept of money, but you can teach them about compounding and investing and earning money through the markets. Roth IRA, so if you have a kid that's working, but they don't make that much money, you can help match their Roth IRA, up to the limits. I didn't like this one, Cory. Another suggestion was paying off high interest debt. I think if you paid off, Cory, your brother's credit card, because it was high interest, don't you think he would just run it back up and spend again?
No, because if I paid off his credit card, I would set specific conditions for him, which kind of makes it not a gift.
Right. So I think you enable people, and I'm not picking on Mike here at all. I just said that, but I think you enable
Mike, if you're watching and listening.
He should be watching and listening. Yeah. So I think you enable people by doing that. I don't like that one at all. Vacations is kind of cool, right? So saying, hey, we're gonna book an airline ticket or something. And then charitable gifts. So like maybe you've got a grandparent or parent, and they are decluttering. So they tell you, Cory, we don't want anything, right? Because we're trying to get rid of stuff. But maybe they're very involved in their church, and you say, okay, well, for Christmas this year, I'm going to give you $100 and as a charitable gift to your church in your name. So that could be something cool in there. So I thought it was a good idea, kind of getting a spin on the holiday gift giving. You don't need to go buy your kids all these toys. Put some money in the 529. They will thank you later. I can assure you, maybe not assure you, but I would think they would.
Jake can explain it on Christmas morning. I'm just kidding, Jake.
That's right. Yeah. So if you put money in the 529 and your kid was like, I wanted that Barbie or G.I. Joe, I could say, hey, you know what? This college education is going to pay off big time compared to
best investment. There you go.
G.I. Joe. All right, good, Cory. And our last one for today, we've got to wrap up here soon, is the storm brewing inside Elon Musk's mind gets out. Wow, this is a good one. This was a hot topic here the past week or so, but let's hear it, Cory. What do you got about Elon Musk?
My takeaway from this, Jake, is that Elon's MO is to garner attention, whether it's good or bad. And just out of curiosity, I did a search, and there have been 10 articles about Elon Musk in the Wall Street Journal since Thanksgiving, which was not long ago. And maybe he's getting exactly what he wants. And maybe, well, what fascinates me though is that it is news because we care and our society cares. But the whole story behind it and the summit, we don't need to get in necessarily to all of that and everything that Elon has said and done. But I just found it fascinating, the takeaways from that, and that's such a big news story. There's that much publicity for Elon Musk, and I can't help but wonder if maybe that's exactly what he wants.
Yeah, I mean, okay. So you can't deny the guy is somewhat brilliant, somewhat maybe even a genius. That does not disallow, though, his faults as a human, where I think he is over-identified with his ego, and a lot of his genius and intelligence has gone to his head. And I think it's like suggesting that someone thinks they're smarter than they are. So I think he lacks humility or humbleness, and it's sad because he's actually, like, to me, it's scary because he plays like the perfect Bond villain. Right? Couldn't you see him in a movie of like trying to destroy Earth, Cory, so that everyone had to move to Mars and he could make even more money? Like, I could see that happening.
Yeah.
Sadly, it's scary, right? So I think he is somewhat of a threat to society. I don't think he's going to blow up Earth, but I think it's just, I don't know what to do about it, but he's an interesting guy. It's easily headline worthy. And, I think he's done awesome stuff for the planet and innovation, but he's a wild card. And I don't think he should be in the public markets at all. I think all of his companies should be privately held so that he can tweet what he wants to tweet and say what he wants to say and do what he wants to do as long as it's legal. But I don't like it when he starts spouting off and manipulating the market returns because of what he says. I don't like that. So
yeah, and has had, frankly, some very strong opinions. And again, he has the platform that people care about, but has some very strong opinions that can be very hurtful to a lot of people.
Right. So
don't use your platform for that.
That's right. That's my point. There's a lot of power there, and he should just go back into his lab and create some more cool stuff. And
yeah, maybe he's doing too much.
Right.
Between Twitter and SpaceX and Tesla and managing all that. Like, I get it. I mean, they highlighted in this article how he referred it to context switching is one of the most difficult things for him to get, to shift gears from here to here to here to here to here and do that all the time. And that's why he said that his mind is like a wild storm, which was a great quote, I must say. That was a great quote. But anyway, I wanted to bring it up and talk about it.
It is, but and I got to think a guy like this with his ego so large is concerned about his legacy. So wouldn't you want your legacy to be, though, this wonderful inventor and innovator, not this guy who's cussing on national television and doing these outrageous things? Like, what are you doing? Like, go do what you are uniquely talented and world class at and change the world that way. You don't need to be doing all this other stupid stuff. But it's easy for me to say I'm not him, but I think he's overwhelmed by his ego. So,
well, and he said himself, he said, you can love me, you can hate me, that doesn't matter. But do you want the best car or do you want the best car?
And I think his truck looks stupid.
Yeah.
Cars might be.
You're not going to get one.
Teslas are sweet. The cars, I'm not going to deny that at all. Got a client that has one. He loves that thing. It's a sweet car.
Yeah, I do too.
But the truck, is he best at everything? That's my point. Is he the best at everything he does? No, not at all.
I wonder what he thinks.
So, well, good. Well, thank you for including that. And thank you all for tuning in. As always, please like and share our content. And we hope all of you have a great week.
Thank you for listening to Upticks. Click the subscribe button to be notified when new episodes become available. Also, be sure to visit our website, falconwealthadvisors.com, and click the Contact Us button if you'd like to meet with Jake and his team.